Vikas Khemani, founder and CIO at Carnelian Asset Management and advisors Johnson right now with his thoughts on the markets and more. Vikas, good morning. Thanks for joining in. Great having you as always. And much as we were talking about GST 2.0 and the RBI actions on the 11th and 12th of this month, there have been 4 or 5 other new reforms, including the nuclear reform being announced. There seems to be an overdrive on reforms. Will the markets take cognizance of that?
As long as Neeraj, there is a continuous process of removing the inefficiencies and progressing towards sort of enabling growth. That's what would always be sort of valued by the markets and by the ecosystem. So I see no reason why, as long as the reforms are done in the right way, which is what seems to be the case. And this is not. I think it's a continuation of many series of reforms which government has been doing ever since they have come into the power. So I think generally speaking, it is a good trend.
Other thing that I noticed, Vikas, it was a weekend of a lot of reading for me, and across global publications, the one thing that seems to come across is that everybody is citing India as being this anti-AI trade, the one which is not rallied while the rest of the EM pack has rallied, and therefore 2026 Indian markets seem set to give a good round of outperformance, even if the world markets were to be a bit skittish. And in some cases, if the AI trade unravels and corrects, it might actually be positive for India. How do you juxtapose these factors?
Yes, I think, see, always there are narratives and narratives are fine. I mean, the point is that you can have AI narrative, non-AI narrative. Fact is that when the AI was building in US and elsewhere, it's not that India did badly. India also had its own, it might not be in that segment, but India was participating in the other segments. Generally speaking, I feel that, I'm quite positive about markets in 2026, backed by a few things. One, of course, in 2025, India has been one of the sort of consolidating market, underperforming market. Last 1 year, markets have not meaningfully moved. The so-called overvaluation, which was there last year, I think with the earning progressing and lots of change happening, I think the reasonable valuation range we have come about. More importantly, I think India has had two major, initiatives. One is in fiscal stimulus, other is in monetary stimulus over last 12 months. Government has cut income tax rates, government has done massive reforms on GST and some of the other reforms you are talking about, which obviously tend to have impact with a bit of a lag. And secondly, we have seen a massive monetary stimulus in form of making liquidity surplus available. Also, interest rates coming down. Government, RBI governor coming out with many credit boosting measures, including financing M&A and all. So I think some massive work is happening in terms of monetary stimulus side. So when both of them have their, and markets are kind of yet to take full note of that. So I do believe that 2026 year will be the year where all those things will be kind of captured by the market. Also, I think if you see rupee has kind of remained a weak currency, so it also becomes much more incentive for foreign flows to come in. So I do believe that there is a good stage which is set for a good 2026, from a market standpoint of view.
Right, sir. As you were saying that there have been multiple reforms that the government has taken, then there is policy stimulus, but the actual outcome or actual growth of the same on ground growth is something that we are yet to see. So by when do you expect that will start reflecting into the numbers, and what is the kind of earnings growth you will expect post that kicks in?
Kind of don't probably agree with that we yet to see. We have already seen corporate earnings picking up. The last quarterly earnings were very, very decent across the board. And so in same we see, in the December quarter and March quarter. So any macro policy adjustments don't have to an impact with an immediate effect. It takes 1 or 2 quarters of lag, sometimes even more, to really get reflected into the corporate earnings. And it's already started happening. And I do see that in times to come, we will only see it accelerating.
And which would be those sectors where we could see the most acceleration coming in on earnings growth front?
So look, again, when the macro policy boost happens, it is across the board. It's not necessarily only targeted towards one sector or segment. But generally speaking, banking and financial services should be a big beneficiary of that, because the credit growth, is expected to come. The cost of capital has gone down. So all those things tends to benefit this. And I think any in general segments like manufacturing, where there's a sort of impact of the interest rate happens. And other thing you must understand the impact of the cut in the interest rate because of the input into valuation. The overall valuation tend to go up. A 2% drop in the discounting rate of any equity asset class takes valuation, everything else remaining same by 30-35%. So, the impact of the cut in interest rates is not only from a corporate profitability perspective, but also overall on the valuation aspect of the markets, and that we very often tend to ignore.
Okay. Um, Vikas, could the texture of the winners in 2026 be different? I know it's always is, right? You could always so many theories about how the winners of the last bull market will not be repeated, so on and so forth, etc. I want to know the Carnelian view. Where do you think the texture of the winners will lie? Will it be in companies which are focused on consumption? Will it be in companies which are focused on where the government is spending? Could it be export driven? What is the texture of the winners likely to be?
I think, like you rightly said, Neeraj, that in every, every year, every cycle, there has been different, sectors which take the lead. And in last 6-8 months, we've been a believer that because of the facts which I mentioned, that fiscal and monetary stimulus, banks and BFSI entire basket will be the leaders of this rally. Consumer, I think, are beginning to look very interesting, and does not mean that by and large entire basket, but for us, even automobile is a good consumer play. And if you see that has been leading the charge on the returns perspective. So generally speaking, interest rate sensitive sectors where the demand is also an impact, driven by the interest rates, as the liquidity also supports them. So we do believe that those sectors will do well, and rest again boils down, Neeraj, according to me, in identifying the right set of companies. I might say the consumer, but in the same time, you will find many consumer companies will not do well, and within that, the pack would some companies will do very well. So eventually, it boils down to stock picking, which is where we focus most of the time. While we are mindful of the macro trend, but our large part of the focus is going and identify a company where the acceleration in the growth is far higher than the rest of the sector, and you're not paying over the top valuations for the growth. If I end up paying more for the acceleration in the growth, then it is hard to capture that in a risk reward manner. So our focus is acceleration in the growth at a reasonable price.
And before we wrap this conversation, just wanted to understand which would be the sectors that one should avoid for 2026.
Look, again, I mean, it's very hard to say one should avoid. Wherever there is a euphoria, wherever you see there's an excesses are getting built, one should kind of be aware of avoiding those things. And I think we've seen in the recent past, more than the sector, I would say quality of the IPOs, quality of the fresh issuances have gone down, and we are seeing a little bit of fraud getting built. And we saw this earlier years also. So many of those companies, even if they are good, you will find them available at a lower valuation maybe 2 years down the line. So better to kind of avoid where there is a euphoria, froth, wherever there is a sort of momentum happening. And secondly, I think one more sector probably, one should be careful about is the whole renewable space, because there's a lot of policy driven happening. I'm hearing that, bit of a oversupply, bit of the, we see at least every week many new companies coming about in that segment. So whenever this such kind of setup happens, one has to be careful.
Okay. Okay, Vikas, always a pleasure talking to you. Thank you so much for taking the time out and being with us today. Really appreciate your time.
Thank you, Neeraj.